Gold and silver just got huge news, and most people watching this right now have no idea what's coming next. There is a decision being made in the halls of the Federal Reserve, a quiet move in the bond market, and a number on a debt clock that keeps climbing every single second. 3 forces, 1 collision point. And by the end of this video, you will understand exactly why the next 90 days could reshape how millions of people protect their savings, because what's happening right now has only happened a handful of times in the last 100 years. Stay with us. This is bigger than most people realize. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one purpose: to help serious, thoughtful people cut through the noise and understand what's actually happening in the global economy, calmly, clearly, and without the hype. Before we begin, we'd love to know, where are you watching from today? Drop your city or country in the comments below. It's always remarkable to see how far this conversation travels. Every so often, a quiet week on the calendar turns into something much bigger. This is one of those weeks. On the surface, it looks like an ordinary stretch of economic news. Underneath, several forces are moving at the same time, and they are all connected. The first force is debt. The United States government now owes more money than at any point in its history. That number keeps growing every day, not just every year. Most people do not think about this number often. It feels far away, like something that only affects politicians and economists. But debt at this size does not stay quiet forever. At some point, it starts to affect how a government behaves, how it borrows money, and how it manages its currency. The second force is the bond market. Bonds are simply loans. When a government needs money, it borrows it by selling bonds to investors. Those investors expect to be paid back, with interest, over time. For decades, this system worked smoothly. But recently, something changed. Investors have started asking harder questions. They want to know if the government can actually manage this much debt without causing bigger problems later. When investors become nervous, they demand higher interest rates to keep lending. Higher interest rates make the debt even more expensive to manage. This creates a cycle that is difficult to escape. The third force is the Federal Reserve, the institution responsible for managing the country's money supply and interest rates. Later this week, top officials from the Federal Reserve will gather at an annual meeting known as the Jackson Hole Symposium. This event does not always make headlines outside financial circles, but for people who study markets closely, it is one of the most important events of the year. In the past, speeches given at this exact meeting have changed the direction of markets almost overnight. A single sentence, chosen carefully, can shift how investors think about the future. Why does this matter to someone who is not a professional trader? Because decisions made in rooms like this eventually reach everyone. They affect how much a mortgage costs. They affect how much a retirement account grows or shrinks. They affect the price of everyday goods. And they affect the value of the money sitting in a bank account. This is why so many analysts are watching closely right now. The pressure has been building for months, but it does not always show up in daily headlines. It shows up in quieter signals: rising bond yields, unusual moves by the Treasury Department, and a growing sense of caution among large investors who manage other people's money for a living. These are not people who react to rumors. They react to patterns. And the pattern right now is one of increasing strain. There is an important lesson in how these situations usually unfold. Governments rarely announce a crisis in advance. They do not send out a warning that says, "Attention, this is the moment things start to change." Instead, the shift happens gradually through small policy adjustments, technical announcements, and careful wording in official statements. By the time most people notice, the situation has already moved a significant distance. This is exactly why calm, early awareness matters more than reacting after the fact. None of this means panic is the right response. In fact, panic is usually the wrong response. Sudden, emotional decisions rarely lead to good outcomes. What matters instead is understanding the situation clearly, without exaggeration and without fear, so that decisions can be made calmly and with enough time to matter. So this week deserves attention, not because of any single headline, but because several important pressures are lining up at the same time. The debt is high, the bond market is uneasy, and the Federal Reserve is about to speak publicly at one of the most closely watched financial gatherings of the year. What happens next will not be announced with fanfare. It will not arrive as a dramatic press conference or a bold declaration. Instead, it will be revealed in quiet policy shifts, careful phrases, and small adjustments that most people will not notice right away. That is exactly why understanding the setup now, before the headlines catch up, matters so much. The people who take the time to understand these signals early are always in a stronger position than those who only react once the story becomes impossible to ignore. Something unusual happened this week, and very few people outside financial circles noticed it. The United States Treasury Department made a move that, on the surface, looked technical and boring. But for those who study these markets closely, it was anything but boring. It was a signal. Here is what happened, explained simply. The Treasury announced it would buy back some of its own older bonds. This might sound like a small administrative detail, but it is not. When a government starts buying back its own debt in this way, it is usually trying to control something that is starting to slip out of its hands: interest rates on long-term borrowing. To understand why this matters, it helps to think about what interest rates actually represent. When investors lend money to a government by buying its bonds, the interest rate they demand reflects how confident they feel about getting paid back in real, meaningful value. If investors start to worry that a currency will lose purchasing power over time, they demand higher rates to compensate for that risk. Rising rates are not random. They are a message from the market. For months, long-term rates have been climbing, even as officials suggested that everything is under control. This is an important detail. When public statements say one thing and the numbers say another, it is almost always wiser to trust the numbers. Markets do not lie the way people sometimes do. Prices reflect the honest, collective judgment of millions of participants making decisions with real money. So when the Treasury stepped in to manage this rising pressure directly, it revealed something important. It showed that officials are concerned enough about the bond market to intervene, rather than simply letting it move freely. Historically, this kind of direct management has appeared during periods of real financial strain, not periods of comfortable stability. Governments do not usually step into markets that are functioning smoothly. They step in when they are worried. There was also a striking moment this week when a reporter asked the president directly whether the Treasury Secretary had been instructed to intervene in the bond market. The response was carefully worded, but it left open the possibility of even larger action in the future if conditions require it. Statements like this are rarely made lightly. They are usually a sign that officials are preparing the public in small steps for the idea that more significant intervention could come later. Now here is where it becomes especially interesting. Immediately after this announcement, something happened in the markets that many casual observers might not expect. The value of the US dollar weakened. At the same time, the price of gold moved higher. On the surface, these two things might not seem obviously connected, but together they form a very clear pattern that experienced analysts recognize immediately. When investors sense that a government is willing to manage its bond market artificially, rather than allow it to be priced by free market forces, they often begin shifting their money toward assets that cannot be created or diluted by policy decisions. Gold is one of the oldest examples of this kind of asset. It cannot be printed. It cannot be issued in unlimited quantities by any central authority. This is exactly why, throughout history, gold tends to rise in value during moments when confidence in paper currency begins to weaken. This is an important idea to sit with. Markets do not need to wait for an official announcement to react. They respond to signals, patterns, and probabilities well before most of the public understands what is happening. In many ways, the price movements in gold and silver this week were the market's own quiet response to a question that officials have not yet answered publicly. How will this level of government debt actually be managed over the long term? There is no need for alarm in observing this. It is simply useful and important to understand that markets are constantly sending messages, even when no formal statement has been made. The recent moves in bond yields, the dollar, and precious metals were not separate, unrelated events. They were connected reactions to the same underlying pressure. This is often how major shifts begin, not with a dramatic announcement, but with a quiet policy adjustment that experienced observers immediately recognize as significant. The Treasury's decision this week may look small on paper, but for those paying close attention, it may be remembered later as one of the earliest visible signs of a much larger story still unfolding. History does not repeat in exact detail, but it often follows familiar shapes. To understand what may be unfolding today, it helps to look back at a period many economists still study closely, the 1970s. That decade offers one of the clearest examples of how a currency under strain can reshape the value of hard assets almost overnight. During that era, the United States faced a combination of problems that sound strikingly familiar. Government spending was high, confidence in the currency was slipping, oil prices were rising sharply, adding pressure to household budgets, and inflation, once considered a temporary concern, became a long, stubborn feature of everyday life. People who had grown up believing that prices simply did not change very much watched in disbelief as the cost of basic goods climbed year after year. In response to this uncertainty, many investors turned toward gold and silver. These metals had one quality that paper currency did not. They could not be created out of thin air by any government decision. As confidence in the dollar weakened, both metals rose dramatically in value over the following years. It was not a single event that caused this shift. It was a slow, building recognition that the currency people were holding was losing purchasing power faster than official statements suggested. Today, many of the same ingredients are present again, though not identical. Government debt is significantly higher than it was during that earlier period. Geopolitical tensions remain elevated in multiple regions at once. Energy costs continue to create pressure across supply chains. And once again, there is a noticeable gap between how officials describe the economy and how everyday households actually experience it at the grocery store, the gas station, and the insurance renewal notice, there's an important distinction to make here. Drawing a historical comparison does not mean predicting an identical outcome. Every period in history has its own unique conditions, and no analyst can say with certainty that the past will repeat exactly. What can be said, however, is that certain patterns tend to reappear when specific conditions align: high debt levels, currency pressure, and a growing gap between official reassurance and lived reality. When those three conditions exist together, hard assets have historically responded in predictable directions, even if the exact timing and scale differ from one era to the next. Silver deserves particular attention in this conversation because it occupies a unique position that gold does not. Gold is widely understood as a monetary asset, something people hold to protect value over time. Silver, however, plays a double role. It is also a monetary metal with a long history of use as currency, but it is additionally a critical industrial material. It appears in solar technology, electronics, medical equipment, and a growing list of modern manufacturing processes. This dual identity means that silver's price is influenced not only by concerns about currency value, but also by real physical demand from industries that cannot easily replace it with a substitute. This combination creates an interesting dynamic. When industrial demand for silver rises at the same time that investors seek protection from currency uncertainty, both forces can push in the same direction simultaneously. This is different from many other commodities, which usually respond to only one type of demand at a time. It is one of the reasons long-term analysts continue to watch silver closely alongside gold when studying periods of economic strain. It is worth remembering that markets rarely move in a straight line. Even during the 1970s, prices did not rise smoothly every single day. There were pauses, pullbacks, and periods where it seemed the momentum had faded, only for the underlying pressures to reassert themselves later. This is a normal part of how markets absorb large, slow-moving economic shifts. Patience, not panic, was the quality that separated those who benefited from that decade's changes from those who reacted too quickly or too late. The lesson from this period is not that history guarantees a repeat performance. The lesson is that certain economic conditions have appeared before, and when they did, they left a measurable, well-documented impact on the value of hard assets. Recognizing these patterns early, without assuming they must play out identically, is what allows careful observers to prepare calmly rather than react emotionally once the shift becomes impossible to ignore. With this historical context in mind, the next question becomes clear: who is already positioning for this shift, and what does their behavior reveal that public statements do not? There is an old saying among experienced investors: watch what large institutions do, not what public officials say. This distinction matters more than ever right now because some of the most respected names in global finance have started speaking publicly about risks they rarely discuss so openly. One name stands out in recent weeks. A well-known investor, the founder of one of the largest hedge funds in the world, published comments warning that recent government actions in the bond market may signal a deeper, longer-term problem. He described this situation as approaching an important turning point, one where the financial condition of the government could move in one of two very different directions. His concern was clear. Without meaningful changes to spending and borrowing habits, the debt could eventually reach a level that becomes difficult to manage without significant disruption. This is not the kind of statement made casually. People who build and manage enormous investment funds do not gain that position by reacting emotionally to headlines. Their success comes from carefully studying patterns, data, and historical outcomes over long periods of time. When someone with that background chooses to speak publicly about currency risk and recommends increasing exposure to gold, it is worth paying close attention, regardless of personal opinion on the topic. What makes this moment particularly notable is that this is not an isolated comment. Several major financial publications, including outlets read primarily by professional investors and corporate decision-makers, picked up and repeated this warning within the same week. This kind of rapid, widespread coverage across serious financial media does not usually happen by accident. It typically reflects a broader, quiet consensus building beneath the surface, even if that consensus is not yet loudly announced to the general public. There's a reason institutional investors often move before everyday individuals become aware of a shift. Large funds manage enormous amounts of capital, and even small percentage adjustments in their portfolios represent significant amounts of money. These decisions take time to plan and execute carefully, often over weeks or months, rather than in a single sudden move. This means that by the time a shift becomes obvious to the general public, institutions have frequently already been repositioning their holdings for some time. This pattern has repeated throughout financial history. Major shifts in asset prices are rarely a surprise to those closest to the data. They are usually visible in advance to careful observers, long before the change becomes common knowledge. The challenge, for most people, is not access to information, since financial news is more widely available today than ever before. The challenge is recognizing which signals actually matter among the constant noise of daily headlines. This is exactly why moments like this deserve calm, careful attention, rather than dramatic reaction. A single warning from one investor, even a well-respected one, is not proof of anything on its own. But when that warning appears, alongside rising bond yields, a weakening currency, direct government intervention in debt markets, and growing coverage across major financial publications, the combination becomes far more meaningful than any single piece on its own. None of this is presented as certainty about the future. No analyst, however experienced, can predict economic outcomes with complete accuracy. What can be said clearly is that the signals currently appearing together are the same types of signals that have preceded significant shifts in the past. Recognizing this pattern early does not require panic. It simply requires attention, patience, and a willingness to think through the situation calmly rather than dismiss it. The signals are no longer hidden in obscure data reports or specialist publications. They are appearing in mainstream financial coverage, in public statements from respected investors, and in the actual behavior of currency and bond markets over the past several days. The only remaining question is a simple one. Who takes the time to understand these signals while there's still room to think clearly, and who waits until the story becomes impossible to ignore?